Hi, Eric. Welcome to Venture with Grace.
Grace, it's great to be here. Good morning.
Good morning. So you're the founder of Revere, which is a yacht for emerging managers. Before that, you work at AngelList and multiple different funds. And why don't we start with how you started your current venture and how you got to where you are now?
Yeah, there's always a funny story, right? In how people get started in venture. It was actually through a friendly referral. Was working at a startup at the time, and through the startup community, obviously you meet a lot of venture capitalists, and I had coincidentally got connected into the fund of funds world,
Mhm.
and they
How do
were
we
hiring.
how do we
Yeah,
accidentally get connected to the fund of funds?
yes.
Please tell me.
Well, it was actually a situation where there was a job posting. So this is actually a good story. There was a job posting that I applied for, and I actually didn't get the job. And I remember, but having a really good conversation with one of the partners. And then I think it was 6 or 7 months later, that partner who I had a conversation with called me up and said, "Hey, Eric, I just remember we had a good conversation. We filled the position, but I wanted to keep in touch, and I've got a side project for you." So I remember moonlighting for a few months working on a side project, and he was really impressed from that. I said, "You know what? Why don't you just join? I'm going to kind of pull my partner veto card, and get you on board here." And so that was literally the winding path into venture. And at the time, I had no background in venture. I mean, I had an engineering degree, so it was technical. Had done risk management, gone through the CFA program, so understood a little bit about finance. But venture is a whole different set of economics and ways you evaluate venture finance versus traditional finance.
For sure. I want to just quickly jump into one of your catalyst experience, which is working at AngelList. Why don't we talk about what were you working on as the head of institutional capital and how it kind of influenced your decision to start your own company?
Yeah, so my exit from the traditional fund of funds world into AngelList was purely from being, having the DNA of an entrepreneur, and I wanted to discover and find a sandbox to flex that muscle. So AngelList is an amazing place. It's got great culture. It's driven by philosophy of both democratization and access. And so one of the things that I believe AngelList was trying to figure out was how, now that they were moving into the family office world, more institutional thinking type of investors coming to the
Mm.
platform, how do you service them? So my joining of AngelList was purely from Eric. You understand kind of institutional LP world. Please help us design and service this platform for mostly family offices or larger investors on the platform. So it was an interesting challenge, partially because you had software as really the core brain of how
Mhm.
AngelList operates, right? It's software, it's product, it's how do we attack everything through an engineering lens.
Mhm.
And as you know, in the LP world, everything really is driven off of relationships, right?
Mhm.
Face to face, coffee meeting. Do they trust you, right?
Mhm.
And that trust is then leading to how they deploy capital.
Mhm.
But in the year and a half that I was there, we found the right mixture of these two things, meaning we did events, and these were kind of smaller curated events where we were engaging with these type of LPs. So they had the FaceTime interaction. We would bring syndicate leads, we would bring aspiring fund managers to these events with us, right? In kind of small doses. And at the same time, we were encouraging them post event to, deploy capital to the platform. And so they got this right combination of like they can touch and feel
Mhm.
the people that they were investing
Mhm.
behind and investing with. And at the same time, they had the ease of access by investing through the AngelList platform.
Mm. I wonder when I think like you mentioned this on the other podcast about like, hosting dinners and stuff. Like I wonder, number one, like were you hosting LP dinners or like what were you hosting like emerging manager dinners? I found that like I wonder so like I got the feedback of like people who were trying to let's say emerging managers trying to meet LPs, they invite other people who invite their LPs to a dinner, but I don't really know if that's like people would incentivize to, bring their own LP to a dinner. I wonder, I know that AngelList was a platform, so you guys have a really good reason to interact with institutional capital at scale. But I wonder what was the dinner like? And then for people who are, trying to raise their own funds, since like a lot of the listeners are emerging GPLPs and like mostly emerging GPs, but like I wonder how
Yeah.
would you kind of like create the ecosystem for yourself to kind of like build the trust, like you mentioned, to creating their own kind of
Yeah, I mean,
LPs.
Grace, we can probably spend 2 hours talking about, what's the right way to create an experience, right, for GPs and LPs. I've done small dinners, done large conferences. I was part of kind of early planning committee of the Raise conference, right, which
Hmm.
is kind of a massive kind of beacon for emerging managers and LPs.
Hmm.
Um, the dynamic is really interesting. I think people, when I use that word experience, people want to meet other interesting people. So you really have to start with that foundation of if they're going to spend their time, especially if people are flying in or we're getting them into a room that isn't, kind of a large setting, they really have to come in, number one, with an open mind, number two, with a clear understanding of how you as an organizer are affecting some sort of value coming through that, right? So
Hmm.
whether it's education, whether it's the matching, right,
Hmm.
in terms of, hey, I know what you're interested in as a family office investor, and I'm going to connect you with the one or two people at this event or at this dinner that kind of match sort of your mandate.
Hmm.
So all these little small kind of nuances and actions that happen, before the event, during the event, and after the event is really what creates this amazing experience. And really that experience is what gets to them trusting you so that the next time that you're throwing an event, big or small, they want to come back. And I think that's
Hmm.
really what I've learned over the years is throwing a good singular event. Probably most people can do, but throwing an event series or building a brand that people say, oh, if Revere's throwing an event, I'm going to go to all those events. That's a whole, sort of different ball game, right? And how do you
Hmm.
plan for that? So long answer short, it's just something that's about brand building, and
Hmm.
then how do you connect with people? Because generally, and this is something I tell the team all the time at Revere, is like they may know me personally as the original kind of entry point of like, okay,
Hmm.
Eric's throwing an event, I'm going to go and catch up with Eric. But really, the diversity of who else is on the team, and I'm a different generation than someone on my team who's 25 years old, right?
Hmm.
They may want to talk to them to say, hey, what are you interested in? What are you seeing in the venture community
Hmm.
versus what I'm seeing? So a lot of this is really when you think about brand building, it's just like it
Hmm.
starts with maybe one or two people, but it's got to become the Revere brand, right? And then
Hmm.
everyone within the Revere community stands for someone who's just thoughtful, considerate, and interesting.
Hmm.
Um, and it's really important because ultimately, I think the foundations of any kind of business that anyone's doing in venture, whether they're GP, LP, or startup, has to focus on brand and community.
Hmm. I wonder when you're creating Revere. So like you guys are kind of like a rating system for GP and LPs. Slash like LPs will be able to quickly identify who will be an interesting target for themselves. I wonder what are the benchmark you are using for the quote unquote Yelp review for emerging GPs because I feel like you said, a lot of it were like trust building and especially fund one or fund two, especially fund one, I guess
Yeah.
like a lot of it were depending on if the LP trusts the GP has the right network and it kind of
Yeah.
execute on the strategy they kind of build. And I feel like the human component is very important. How does the system come into play to kind of evaluate
Right.
these like soft skill related things?
Well, I mean, the same way, Yelp is an amazing destination,
Mhm,
right? It's because people trust Yelp has done some amount of curation and sanitizing of the reviews, right?
mhm,
The platform in this case, Revere, has to have a very strong brand of being independent, right?
mhm,
And servicing both sides of the community.
mhm,
So that's really when we started the rating system. It was, controversial at the time because GPs are like, well, what happens if I don't get a good score, right? And of
mhm,
course, LPs are a little bit hesitant because they're saying, well, maybe you're only publishing those fund managers that have good scores, right? And
mhm,
you might be kind of biased to kind of pump up those scores.
mhm,
So it takes a initial kind of push of momentum, right, for
mhm,
people to kind of appreciate what you're trying to do in terms of number one, you have to have enough data to be able to say,
mhm,
well, look, we've gone through enough managers, so we know what good looks like compared to what bad looks like, right? Or what
mhm,
looks like, something in between. And then the second thing is you really have to come up with a system, right?
mhm,
Because at the end of the day, you cannot just simply say, well, look, Eric's opinion thinks this is a good manager and
mhm,
this is interesting, and so you should trust Eric, right?
mhm,
So how do you move beyond simply an opinion-based system to something that says, hey, look, there is a scoring framework here. There is a scoring matrix. There is a clear way that says this is within the different categories that we're investing.
mhm,
That this is how they rank, right? If
mhm,
here's a good example, like if we were talking about sourcing, was one of the 20 categories that we're evaluating. How do you define what is a good sourcing score,
mhm,
and what is a bad sourcing score, and being transparent about that. So that just takes time, and
mhm,
it's time that we need to educate the GPs who are coming onto the platform. And it's also time for our internal team to collect the data to be able to produce that distribution of scores.
mhm,
So the first 6 to 8 months was a lot of dog fooding this on both sides, and then but when you get through that first, I would say, kind of 50 reports, it just has this like kind of magical moment where you're like, hey, this just kind of works, right? Where you feed the data into the system. Obviously, the analyst is kind of providing context to it,
mhm,
but then the scores that come out of that are just seamless. And that's when you've got a really good system. And then, of course, then at that point, most of the fund managers were publishing, like we had like a over 90% publish rate that they would go through the whole process, receive their scores, and it said, yeah, go ahead, we want to publish this to the database. So that's the
mhm.
ultimate point of validation.
I wonder, you mentioned a couple really good points. One of it is like you need to know what good looks like. What does a good fund one look like? What would be the things that close LP? Obviously, if you have like a really good track record, let's say you're like Sequoia spinoff, like that's a great
Right.
place to start. But like, most emerging managers looks like it, I feel like people are scoring towards like younger and younger people who have done a couple
Right.
of syndicate and starting funds. And I wonder like what does good look like? And can you maybe like without naming a particular fund, but like maybe tell us about like, what
Yeah.
was their like how do they kind of like put together a first fund, and then how
Mhm.
does Revere kind of rate them to help them attract maybe the right LPs for them.
Yeah, I mean, good is always relative. And when I talked about kind of we have like 20 different categories that
Mhm,
we score. We don't have a composite score, right?
mhm,
Because um, by definition, different types of LPs provide sort of different weightings on things that they think are important in terms of
mhm,
how a fund manager is generating, good performance. So,
mhm,
family office LP that might be really interested in co-investing, they may look at that like kind of co-investment score and say, hey, like I weight that a lot higher
mhm,
than the value add score or the sourcing score for management, right? An
mhm,
institutional investor working at an endowment might say, well, look, it's track record, and then maybe a little bit of sourcing.
mhm,
um, so when I use that term kind of good. It's always going to be a little bit different. And this is something that,
Mhm,
I learned when I was in the institutional side, and it's something we also learn when we talk to a wide range of different types of LPs.
mhm,
Now, with that said, like, how would I create separation? It really, at the end of the day, is all about potential. Because if you think
mhm,
about most fund managers, it takes three full fund cycles to have, full DPI track record, right? If you think
mhm,
about TVPI versus DPI, there's a lot of great
mhm,
TVPI in funds one and two, but then by fund three, really, you should be fully aware and capable of actually providing, full distributions to your LPs.
mhm,
So, in this kind of lens of like potential, what you're really looking for is someone who has that ability,
mhm,
putting themselves in front of a founder to be able to convince the founder. The founder's like, "Hey, I want you in. I want you in as an investor. I want you in as on my cap table." Right.
mhm,
So that's a really, really important kind of evaluation point, and that's really where I kind of start about evaluating potential.
mhm,
Now, the other, let's just call it 20 or 30%, is that same sort of dynamic of putting that GP in front of a founder absolutely has to work when you put them in front of a potential LP,
mhm,
right? And you've probably heard this before. It's like, hey, they're a great investor or they're a great founder, but they suck at fundraising. So one of the really, really important skills, right, which can be learned over time, is like part of being a good fund manager is you also have to be really good at fundraising. I mean, by
mhm,
definition, but also I think that's an important component of being a complete investment professional.
mhm,
So when you look at potential and you see how do they interface with founders,
mhm,
and then how do they interface with LPs, when you put those two
mhm,
things together, that kind of gives you some sort of quotient of like, hey, this is where I would put my money behind this
mhm.
manager.
Totally. When you talk about like, the GPs who are really good at convincing founders, what exactly would be the benchmark that you use to judge their ability? Is that like, okay, so since I feel like a lot of the emerging manager, they may not have a lot of money to invest to like deploy into like I don't know like 50 companies and like just convince everybody who have a good company to like
Yeah.
put money in. But like I wonder how do you kind of like how does that shape how does one put together like a deck that's like indicate that like I will be getting into the most competitive deals. Also, what exactly consider as a good deal? Because I feel like a lot of people would use if the second round or like the follow-on round are invested by like a really tier one
Mhm.
uh firm, maybe that's a good indicator, but I wonder, so like how exactly, but like who would know? Like, like the Airbnb or like Uber of the world, they're not like famous for like being very easy at like fundraising at the very beginning, right? But they turn out to be a good investment. I wonder how do like, how would you say would evaluate as like a good company and from like the LP's eyes, and how would the emerging manager kind of like showcase that like, you know, I would be able to get into the companies, but without like,
Mhm.
actually putting money in since like it's very early stage.
Yeah. Well, so you're opening up another like really, really interesting and long conversation. A few things that I would mention is, I mean, there's a wide spectrum of what are the attributes, the qualities, even like kind of personality styles that resonate with founders, right? And now being kind of a founder myself, I've seen this when I've gone through and I've done fundraising and sat across the other side of the table. The second thing is it doesn't happen in a vacuum, and I'll kind of unpack all this stuff. And the third thing is you're absolutely right. The perception of what an LP thinks is a good quality of like um, GP founder fit could be
Mhm,
actually very, very different than the founder lens of what I actually think is a good fit for me as
mhm,
an investor amongst kind of maybe a diverse cap table. So the first point in terms of the spectrum is, I mean, there's going to be some companies, especially if you think about deep tech, where they're going to value very, very technical expertise, right? Or that leadership, the thought leadership of that GP within a particular community around, scientists, engineers, or,
Mhm.
AI, whatever it might be. And so that becomes kind of a singular point of like, okay, I want this person on my cap table because they're the thought leader in X, Y, and Z.
Mhm.
And then it goes on the other end, right? If you think about this
Mhm.
very technical, then you have on the other end something that could be very qualitative. Like this is
Mhm.
you hear this all the time. Like this is the first person I would call when I run into issues, right? So
Mhm.
there's a personality fit, there's an empathy kind of quality to it where that particular founder says, this is the first person that's going to help me through good, bad, and ugly problems, right? And there's
Mhm.
absolutely value to that because then that kind of engenders, pro rata rights. And, when that company gets to unicorn status, there's going to be all sorts of like ways they want to pay back that fund manager, that
Mhm.
investor that was there in the beginning.
Mhm.
So that's really, if you think about kind of the two endpoints of this concept of a spectrum of what resonates and what are kind of qualities, and then there's all sorts of stuff in between. So the second point that I was talking about in terms of this kind of question doesn't operate in a vacuum. Really, where you need to connect the dots is um, the perception or the articulated on the slides that are coming through in the pitch deck about why they resonate with founders has to match what the actual fund thesis is, right? So
Mhm.
if you have someone highly technical who's just doing like a YC demo day fund,
Mhm.
that's a complete mismatch, right? Because we all
Mhm.
know YC demo day funds are access,
Mhm.
right? And kind of like, how do you get in before the demo day?
Mhm.
So that's the other thing. From an LP side, you've got to really be very careful, right? Because you can
Mhm.
look at this person and they can pitch um, amazingly well. And you can say, oh my gosh, I can see how like every founder would love to have this person on. But then you have to also evaluate, well, does that actually lead to them generating good performance as a fund manager?
Mhm.
So that's a second really, really important point that I think sometimes, and look, I've been a victim of this where you're just like,
Mhm.
hey, like anything, anything this person touches is amazing. I just want to be part of it. Um, but you have to say at the end of the day, does that actually map to when they say I'm going to be writing, 250 to $500 checks and $500,000 checks, and then I'm going to invest at this stage and have this type of portfolio construction. Many times it doesn't always kind of jive, right? So that's the
Mhm.
part that if you put that institutional hat on, that you got to make sure is really tight.
Mhm.
Um, and then the final piece of kind of part of this answer is really from the LP side. They're really trying to look for people who can build a franchise,
Mhm.
right? It's not a one and done manager, although I think there are good investors out there that can do one or two funds, make great
Mhm.
returns, and go off and do something else. Um, for LPs that are in it for the long game, they want to back a first time fund manager for the next three funds.
Mhm.
So that's the other variable that they're kind of like weighing in the back of their heads. Like, can I
Mhm.
see them, building a team, um, you know, having a platform, putting infrastructure behind the brand, especially if it's, kind of a solo GP.
Mhm.
Those are the other considerations that kind of all have to work together across those kind of three evaluation points that I just discussed.
Mm. I wonder, I think I got a couple questions for like each of the characteristics that you mentioned. Like the first person to call one, like I've heard like a lot of people would say, oh, like I'm the first person the founders would call. And I'm sure like some founders would say that about an investor, but like I don't really know if that um translate into like if they could get like I think like number one question is like um this also comes down to besides like having access to these founders and then serving founders. I think you should be able to, I guess, like there's like, oh, okay, I'm sorry, my brain is like all over the place right now. I
Yeah.
think one of my question is like portfolio construction, because I feel like you mentioned, like with I feel like having a access to putting a small check into a company, sure, but like I mean, what about like your like full on to like keeping the certain percentage into a company, I feel like there's a lot of science into it. And like, do you see any good like template for like portfolio construction for our first fund? Should people be like, 25% investing into like, let's say 50 company, but like 75% using to, investing in like maybe I don't know, like
Mhm.
10% out of your top portfolio. If you're like advising the emerging managers of today's age, and like what would you say would be like a really good template for portfolio construction?
Yeah, we, one of those kind of rating scoring categories that we talk about is, within the firm management category, and we ask all the fund managers to send us their model,
Mhm,
right? And you get some very basic models, which is fine, and then you get some very very complex models, and it's a great window into the way that this fund manager is thinking, right? Do they want to
mhm,
be more prescriptive in terms of how they see it? And invariably, nothing ever goes according to the actual model, right?
mhm,
What you don't want to see is someone saying like, okay, I'm a seed stage investor. What you don't want to see is them like investing in like a pre, IPO round, right? So that's
mhm,
kind of a big red flag. But them saying like my average check is gonna be 250,000, but it ends up being a little bit more
mhm,
because they, kind of feel like it's a, they want a little bit more concentration and ownership. That's perfectly fine. It doesn't mean they're like completely doing something different, right?
mhm,
So portfolio construction is always um, one of those things that I think LPs just kind of latch onto. It's like a security blanket. It's like, oh, this if they don't have a good portfolio construction model, or I don't feel comfortable that they know how to deploy capital, that's an easy kind of way to say no, like,
mhm,
come back when you've proven it, which is a little bit of a crutch in my opinion, right? Because it's not going to be the portfolio construction that determines the returns ultimately. And this is a, a lot of what, is out there in terms of the data and scientific research papers is like their ability to find the outliers,
mhm,
right? And
mhm,
so, that phrase of finding outliers, you don't model that, right?
mhm,
It's
mhm,
like you're able to do it in some form or fashion, or you're not. And
mhm,
what's difficult about evaluating emerging managers is uh, you don't know until after the fact, right?
mhm,
So here's an interesting story. I was just coming back from a trip in Japan, and I had brought with me 12 emerging fund managers from our community to meet with a bunch of LPs in Japan. And I did a little bit of a study. I said, okay, let's look at the track records
mhm,
of these 12 fund managers. And when I collected all the data, I said, well, these 12 fund managers actually have backed 42 unicorns, and they were all very, very early investors, right?
mm,
So that as the slide that I was kind of presenting as I was teeing this up in front of the Japanese LPs, I said, look, you may not recognize their names. You may
mhm,
not, I mean, they may be small funds. Some of them were like as small as $50 million funds,
mhm,
but absolutely, these are people who have some unique ability to find these companies that become unicorns. And this is why you should pay attention. And ultimately, that is like kind of the singular, you know, factor here when, why people should be investing in early stage venture and why people should
mhm,
be looking at emerging managers because they're
mhm,
getting in early and then they have some ability, most of them, many of them, to find those outliers.
mhm,
Um, so it, the, just I'm basically saying like portfolio construction
mhm,
is a way to check the box, but
mhm.
when you're really drilling down to like, what are the handful of funds that I actually want to put capital into, you're really looking at it from that lens of the outliers.
Mm. I'm taking notes. You mentioned about like the 12 fund manager who back like 42 unicorn companies. Um, is there like, so I guess like, is there a lot of people that are, let's say if there's like three people that are backing 40 unicorns and then the other couple people who are backing like some of them, or like how does it how is like the emerging manager unicorn distribute? So like, I mean, I wonder if there's any kind of like science to um what
Yeah.
qualify as like a good emerging manager and what kind of track record they have to be doing before they start their own fund.
Yeah. It's you highlight a really important point because if you try to rifle shot, like I only want to find that one fund manager that had like, 20 of those unicorns,
Mhm.
then you're gonna get a tremendous amount of volatility of like, okay, your probability is really, really low. But if you looked at this as well, I did some sort of I went through a thoughtful process of picking 12, and
Mhm.
collectively these 12, and let's just hypothetically say they're all solo GPs.
Mhm.
So if you had 12 GPs and working at one big firm like a Sequoia that
Mhm.
invested in 42 unicorns, you say, "Oh my God, that firm is amazing,"
Mhm.
right? So if you kind of bring that back into like, these 12 fund managers are individual firms, but collectively they back 42 fund managers. This is what supports the notion that you have to have a portfolio, a basket of emerging fund managers, because precisely you don't know what the distribution of like, okay, who is the one or two kind of hotshot funds that kind of
Mhm.
have 50% of the unicorns. And then
Mhm.
you might have the one or two on the lower end that might have one or two,
Mhm.
right? But collectively, they're amazing. So that's one of the fallacies I think that when people LPs who are very used to kind of traditional venture allocation, where they say it's like, okay, it's NAA, it's General Catalyst, it's Andreessen, it's brand name X, Y, and Z, it's Founders Fund.
Mhm.
They can afford, right? And I would say that's the right play is like finding a very large firm with multiple partners with different
Mhm.
types of strategies where you get kind of the broad exposure that collectively produces these kind of outperformers.
Mhm.
To apply that same formula into the emerging manager community, you can't just pick one or two fund managers,
Mhm.
right? Because literally you're just like trying to like rifle shot and say, okay, who do I think out of the talent pool is going to produce these returns?
Mhm.
It's just a very different model of thinking.
Mm. I wonder for the fund managers who are able to let's say getting into a deal that like Sequoia leads or like all these like tier one fund leads, like if they're able to having access to these deals, does their fund actually cumulatively performs better than the people who are seeking like the little gem in like a really random sector?
Yeah, I think, well, my first observation is all
Mhm.
the bigger funds getting bigger, and
Mhm.
they're all generalists and they all have multi-sector type of approach. So
Mhm.
um, I would venture to say that most emerging managers will have a good proportion of their portfolio companies go on and get funding from, let's just call it a tier one VC.
Mhm.
So, as a statistic, I don't think today it used to, like when I
Mhm.
first started investing more than 10 years ago, it used to be a barometer. It used to be kind of a form of a track record to say, look, 60% of my portfolio companies, if I invest at the seed stage in the subsequent rounds, get a tier one VC.
Mhm.
I mean, that I remember that used to be a stat, and that was a stat I used to use when I was fundraising for the emerging manager fund of funds.
Mhm.
So, but today it's just like it's just structurally like every big fund is going to
Mhm.
be trying to sift through and get deal flow
Mhm.
from kind of the sea of seed stage emerging fund managers. So, from that sense, I don't think as an LP, right, for
Mhm.
sophisticated LPs, that's no longer carries the same weight as it did
Mhm.
before. I think what now is more important is, okay, did that early stage seed manager have the ability to put more capital in at that
Mhm.
round? And as you know, we talked about AngelList, right? AngelList, does SPVs. They have syndicate leads, right? Like I've seen a lot of data
Mhm.
where, in that Series A, Series B, Series C, that early stage investor had the ability to put more capital in. And so now I think that's the type of question that LPs have to ask is their capacity, their capability to put more capital in a situation where that the company is oversubscribed,
Mhm.
right? Um, So that's where there's been some evolution around this concept of like tier one VC, backing the portfolio companies and emerging managers. Now you have to kind of go a layer deeper into the
Mm,
analysis.
mm. I really like what you said about like, since like the tier one funds are getting a lot bigger, so like it's kind of unavoidable to like have some of your like portfolio company to be not your, but like emerging managers like portfolio company into um getting them into like a really tier one funds like portfolio. And I wonder when you talk about like, we discuss about like the first person a little bit like of the access point, and then like I would say for the first person to call later, but like let's talk about like the franchise potential. Uh
Mhm.
since you've seen a lot of GP and LPs, like what are the sentiment towards like, you know, I guess, like, how do people actually having a Fund 8? Because I feel like, there's a lot of people starting Fund. I don't know if there's any graduation rate between, like I think the first Fund to second Fund was, like, something like 40% people graduate to a second Fund, but, like, I wonder if there's any statistic that's kind of, like, indicating that how many people actually have built a franchise, and, what are the differences between people who were able to build a franchise versus people who were just, like, their fund just died after, like, I don't know, before Fund 3?
Yeah. So we talked earlier in this conversation about, that kind of quotient for potential, which I think is, one of the factors. But if you think about the structural dynamics of going from fund one, let's just say fund one to fund four, right?
Mhm,
So fund one and fund two, generally it's going to be smaller LPs, friends and family, typically around the same fund size, right?
mhm,
And then when you reach fund three, you generally have enough of a track record,
mhm,
even if it's unrealized, that you're now starting to approach more institutional investors, family offices, maybe smaller foundations and endowments. And
mhm,
then, as I mentioned before, by fund four, you should have DPI, right? And DPI
mhm,
is the barometer that larger institutional LPs are kind of measuring success.
mhm,
So when you look at this type of fund one through four type of evaluation and evolution, it's all about the dynamics of like who your LP base is.
mhm,
So part of what's lost in a lot of like this kind of measurement and statistics around graduation rates
mhm,
is it largely depends on the philosophy and strategy of how that fund manager is approaching different types of LPs according to fund one through
mhm,
four. And I think the reason, actually, I know the reason why a lot of spin out funds are successful in this kind of concept of raising money is because generally the firm that they're spinning out of is making introductions to their
mhm,
LPs on their behalf. So they get the fund raised very quickly. And it's a little, sometimes a little bit of a false positive because you may think, oh my gosh, they had one close, raise 150 million, they must be great, right? Must have had like an amazing track record.
mhm,
The actual reason is they just had an easier time and easier access to capital. And of course, once you land those more institutional LPs in your fund one, your fund two is already now kind of institutional LP base.
mhm,
So this is a really important point because this is kind of like the haves and have nots in emerging fund managers, which is, when they struggle with fundraising, it really is not necessarily about their potential or their quality as an investor. It's really about how do they actually have ability, skill, or access to networks to capital.
mhm,
And this was really, the foundation of why, I started Revere was just like this kind of dichotomy of there's all this like great hidden talent
mhm,
not able to access more institutional or more long-term capital.
mhm,
I mean, it's a tremendous shame and it's a tremendous opportunity, right?
mhm,
So I think this franchise concept is really important because ultimately, I think all fund managers at the early stage should be thinking about franchise. And franchise doesn't necessarily mean they have to become a big fund,
mhm,
but franchise has to mean they're the leader, they're the brand, they're the go-to in X, Y, and Z. Um, and today, most of it is just revolving around their ability to fundraise.
mhm,
And I think that's got to change. That should change.
mhm. Um, I wonder I wonder I want to quickly say hi to the audience. Hi, David. Hi, Mohammed. We're gonna address your question a little bit later. One of the question is, I wonder when it comes to emerging manager fundraising. As you mentioned, like the front one, two, three, like a lot of it were like friends and family kind of capital, and I wonder if there's any statistic around like how many people you have to pitch to get to close your fund one. That's like on average, because I've heard of like really like from friends who are raising. Some people raise like some people chat with like 1,000 people, some people chat with like 500 people, some people chat with 200 people. So there's like a wild range of things. I
Hmm.
guess like if there's any stats on like the first fund size and how many times they have to chat with LPs to kind of close it, and what are the kind of like ways people are um able to like go beyond friends and family, because I think like closing a fund, um I think it takes more than a family because it's a fund after all. So I wonder what's
Yeah,
your
this
like
is
overall thoughts.
um yeah, this someday maybe this is, I'll sit down and write a book around fundraising strategies. I mean,
Oh,
this
I
is
would totally
another
buy it. Pre-sale on our link down below.
uh
Pre-sale Eric's book.
yeah, this is a really meaty topic. I mean, I think the way I would answer this is, or the question I would ask is like, how many conversations did it take for you to get the anchor
Mm,
LP? Because for the most part, most emerging fund managers or smaller funds, I mean, they kind of need the anchor, the first or second anchor, to
mhm,
be the catalyst, to be the signal for like
mhm,
other people to start coming in, right? And
mhm,
then it starts to phase in there, right? Because your first close is like, hey, I've got these two anchors, 25, 30, 40% of my fund is now, com- you know, I've got commitments there. And then you close the next wave who is kind of waiting for
mhm,
the first close. And then you have the final close people who are like saying, hey, I'm always going to be last in because it's like
mhm,
de-risk from a fundraising perspective. So there is this interesting psychology in terms of how LPs are constantly looking at kind of where are you in the fundraise, right? And this is
mhm,
also why a lot of GPs complain that LPs are not responsive. They never give them a firm no, because LPs are constantly saying like, okay, well, where do I want to slot in? Do I want to be first close, middle close, or final close?
mhm.
And they're not going to. They don't tell you this. No one says
Mhm.
like, oh, I'm a final close investor, so come talk to me in eight
Oh,
months.
I
No, they
I
just
heard like most people like I mean, of course, like most people wanna be final close because it's like a lot like their risk are a lot lower, as like I
of
heard
course,
people raise
yeah,
like the first part of the first like maybe like let's say call it like a 25% of the funds like for like a year like after fundraising, and then the last like 75% just close within a week or
yeah,
something. So I've
yeah.
heard of like a lot of like really really
The
interesting like kind of like
the
dynamics in there.
The
Right.
anchor and the first close is always the most important. So it's like, do whatever you have to do, fly wherever you have to fly, to get that first close and the anchors in. And this is also why I think it's perfectly fine to give up economics
Mhm.
to those anchor investors. And this is also a very controversial point, as well, right? Whether it's
Is
GP,
there kind of
GP.
is there kind of like a safe for emerging manager kind of thing?
Um, Not formally, because usually, in my experience, usually that anchor investor comes in two forms. It can come
Mhm,
from like, a fund of funds where they're going to be, less focused on like additional economics and more about like, hey, I'm choosing you because I believe in this.
mhm,
But then when you're in the family office world, right, and they're saying, well, look, I why should I be able to double dip if I'm going to be 20% of the fund? I want to take some
mhm,
carry,
mhm,
which I think is okay, right? But that's kind of based off of the nature of that type of LP. So, so it's hard to put, a formal contract. Now, if Grace, if you said like, Eric, I'm gonna give you a bunch of money and you start a fund of funds tomorrow, I do think there should be a form of a like, hey, if you're a first mover or believer,
mhm,
here's like kind of a standard way that you can um, incentivize
mhm,
those first close investors. And I think, with the regulations that are potentially coming online, I mean, this
mhm,
disclosure, side letter stuff, all will be kind of in the open, right? So it's
Mhm,
not like something you hide and says, "Hey, I gave away half of my management company."
mhm,
It's going to be in the open, right? So you, as a fund manager, have to be thoughtful, and then the industry overall has to have some standardization of how these contracts work, right? Same way that
mhm,
the YC safe.
mhm,
I think at some point it's gonna happen just because it's a very necessary requirement for emerging fund managers to get those anchor investors, and you've got to
mhm.
incentivize them somehow. Absolutely.
Mm. What's a good, like, incentivized formula there if there's any formula?
Yeah.
Like, let's say you gave, I don't know, X amount of discount or, like, what would be, like, a good equivalent of a incentive thing?
Yeah, personally, I kind of use a 20-20 rule, right? So
Mhm,
if I'm coming in as 20% of your fund, um, the starting point is 20% of the GP carry.
mhm,
And I'm not going to touch there's some people who want to take equity in the management company. I think that's a whole different conversation. But if you think about just like, okay, GP carry on your first fund, and then maybe some trailing kind of GP carry on fund two, assuming like I re up in fund two, I kind of use that 20-20 because you generally don't want to have one LP be like 50% of your fund, right? That has a lot
mhm,
of kind of perceived fundraising risk. But 20% is kind of a meaningful check.
mhm,
And it gives you kind of the right signal to kind of, I mean, absolutely, you can do a first close with one
mhm,
LP and 20%.
mhm,
So I start there, and then you can kind of flex up and down. I mean,
mhm,
it's always a negotiation, right?
mm. You mentioned about, like, equity in the management company, can you unpack that a little bit?
Yeah, there's a in other asset classes, it's very common, like this kind of staking or seeding concept where certain types of LPs, and most of these have been like kind of family offices, will actually help put the fund manager in business.
Mhm,
And as part of putting them in business, not only with capital, they might provide
mhm,
like back office support, outsource CFO. They actually would take some equity in the management company.
mhm,
And once you take equity in the management company, the cash flow modeling for an LP is completely different because now all of a sudden you're participating in all the future profits, all the future
mhm,
fees
mhm,
of every subsequent fund that they raise, right? So it's
mhm,
obviously more lucrative for
mhm,
LPs. It's more, kind of dollars out for the
mhm.
GPs, but in some instances it can make sense because if you have to get in business and this is the only activation point, then sometimes you have to do it. It's the same way, when I raised a seed round, like you have to
Mhm,
give up some equity in the business
mhm.
for the exchange of having capital and runway to run the business.
Totally. How is, I guess, like, I guess, like, I heard people were selling, that's, like, part of their, um, management company. I guess, like, I guess, how does that work in general? And, like, I understand that, like, I don't know, like, I don't really know how much it will be in your management company in general, like, how, like, I guess I wonder, like, for the audience who may not be super familiar, can you unpack that a little bit?
Yeah, I mean, the management company is just like if, me running a startup and I'm selling equity, right? And so the difference is, in a startup company, when I sell the company or, there's some exit, you get X percentage of the proceeds. With a management company equity position, the returns to the management company are in the form of like they're getting management fee
Mhm,
and they're getting a share of the profits, right? They carry from not just fund one, but
mhm,
literally every single fund. Now, at the same time, the management company has expenses, right? Management
mhm,
specific expenses that they have to bear that
mhm,
are different than how you categorize expenses when you're running a fund, and that GP entity of the fund, can charge some of those expenses back to the LPs. So it really is the concept of like you kind of have a company, right, that kind of
mhm,
owns everything and is
mhm.
responsible for running all the funds. And if you're an equity holder there, you kind of share in that P&L.
Mm,
And that's why I said like kind of as an investor looking to invest in a management company, like kind of that dynamic
mhm,
starts to look a lot more like you're investing in a startup than you just simply participating as an LP in a particular GPLP entity fund.
mm,
So I don't think I mean, it's not common, partially because of some of the complexity around that. And also, at the end of the day, it's, there's liabilities. I mean, there's risk if you're part of the management company. Whereas if you're only just kind of part of the GPLP entity and you're maybe taking some percentage of the carry, right, there's more of a limited liability there.
mhm,
So there's kind of some of those nuances that kind of play into it. Um, but I also don't think it's what is needed or required to get in business. I think it's perfectly fine to offer some carry in that first fund or the second fund to help get that anchor investor in.
mm. I wonder, how do you see people sustain themselves when they have like first three funds that are like smaller font size? Since the management fee, it's like, let's
Yeah,
say if even if you just like front load like 2% of like 10 years, like even if you just front load like I don't know the first like 3 years and you take maybe 60% of your management fee or something. I don't really know if there's a standard, but that's still like a really small fee. Let's say if you raise like I don't know like $3 million fund that your management fee shouldn't that be like I don't know 60K or something like
yeah,
how does that work to sustain themselves in like the Bay Area?
yeah.
Oh, by the
I
way,
mean,
hi, LinkedIn user. We'll address your question later, but keep
yeah,
going. Sorry.
it's hard. I mean, it's definitely hard to, especially that first fund when you don't have a lot of fees and you have legal bills and things like that. It's hard. I mean, the good news is by fund two, you're stacking fees, so that kind of gets you. My sense is that you're kind of now break even or cash flow positive, where you're now like,
Mhm,
okay, maybe I can hire the team. The positive trend here is like you have outsourced service providers
mhm,
that fully recognize that they can't, like big law firm is, you can't charge them
mhm,
standard rates, right? So they're all these service providers now do have specialized programs for smaller funds that
mhm,
where it's a little bit more templatized and it's not a lot of billable hours.
mhm,
And then you have, AngelList and Carta and Aduro. You have all the fund administrators, which is
mhm,
doing a lot of the back office lift.
mhm,
They all have, you know, by virtue of competition, they all have kind of, reasonable rates
mhm,
that they, for fund managers to have fund administration. So the cost curve is coming down,
mhm,
and I think it's just a question of like, it's a single GP, if it's two GPs, right? Like that's kind of the math of like kind of where the management fee starts to come in. And two to 2.5%. I've seen, some people, I'd say 20 to 30% might front load that a little bit for first fund. I think that's okay. You just
mhm,
want to be transparent to your LPs around that.
mhm,
But by fund two, like everything should start to normalize and look like kind of standard, 2 and 20.
mm. Um, how do people like do people do like first fund when they're like actually part like a operator or like how do people actually do the first fundraise? Because I feel like the
Yeah.
standard that I've heard of like the font size is like typically below 10 million and like um typically even smaller. So
Right.
I wonder like if there is like anything people would do to kind of like survive. Besides like, you mentioned about like the service provider part, that's like literally the management fee component. That's like basically that's your expense, right? But like you still have to kind of sustain in a really just like sustain yourself. Like do people just like basically use up their savings or do people kind of like start, consulting or I guess like what's like the pattern that you've seen people have done this successfully like during their like I don't know first year of like
Yeah,
building.
I mean, this is why I think, the concept of syndicates at Angelus is powerful, right? People
Mhm,
can be sharing and monetizing their deal flow while they're an
mhm,
operator.
Mhm.
or an angel investor. I wish more people did it, just because I think it's a great proving ground
Mhm.
for them, to prove it themselves and also prove to LPs. Um, so I think that's a good way to be essentially a part-time investor. But at the same time, if you're a serious LP, like you want them full-time
What time?
focused on this, right? So this is
Mhm.
always going to be a little bit of a sticking point. So what I always advise is I think, don't optimize for fund size on fund one, right?
Mhm.
Optimize for your ability to showcase that you can get into good deals, you can help companies, and you can get those companies to the next stage. And so if you have to be suboptimal on fund size, meaning instead of doing, 25 investments, you're doing 12 within, a shorter time period, shorter investment period, and then coming back to market
Mhm.
with kind of a larger fund, that's okay. And I think actually that probably should become kind of the norm if you are not going the syndicate route.
Mhm.
And again, it goes back to what we've been talking about. This common theme is there's got to be some kind of standard practice around
Mhm.
what's acceptable, not acceptable. There's just too many wide ranges of like, what do you mean they're like a $5 million fund is going to be deployed in 6 months? Like, most people are just saying that's a big red flag, but you're just kind
Mhm.
of a stub fund until like you can prove the track record.
Mm. From I guess, like, I wanna, like, at the end, I wanna give a shout out to, like, Revere's, like, products. What about, like, you walk us through, like, as a LP, what do I see in the product, and how do people use it, and, like, all that kind of thing good things.
Yeah, I mean, today we've got like an amazing emerging manager database, right?
Mhm.
So, more than 500 funds in our community that we've interacted with. We've got profiles on, you know, close to 300 of those. We've got full like diligence reports, these kind of rating reports on more than 150. So we've got an amazing stockpile of data, right? That's always kind of what we lead with LPs is like, we've got more data, better data, than a lot of
Mhm.
people on emerging fund managers. And then how
Mhm.
do we activate that for LPs is really where I think, our BIS model kind of, splits in different ways. There's some people who just want to commission a report, like, hey, I met Grace.
Mhm.
She's on my short list and I want to, commission a report for Revere to do the full diligence.
Mhm.
We have some people who are interested in like actually subscribing, pitch book style,
Mhm.
like to the database, right? And we're kind of thinking through what that development looks like. And then I think what's most interesting, and really where we think a lot of the future business for Revere is there's folks out there like very large corporations. Like I was in Japan and talked to several of them where they're like, hey, we need help accessing innovation in these core sectors. And we recognize, and what we've been educating is like for you to get access to those type of technologies and the startups, you have to interface with emerging fund managers, right? They're the ones who are on the front lines and they're going to give you the scale, the
Mhm.
leverage that, within 5 fund managers in a deep tech sector,
Mhm.
you're going to get access to all those companies that they see,
Mhm.
both of the ones they invest in and the ones they don't. So I think in short time, I think we kind of want to be in this like kind of Cambridge Associates model where people are saying, here's $50 million, we're going to invest in these categories. And then how does Revere, with their data, their software, their community, help us put that capital to work? And ultimately, that's the goal, right? When we talked about in the beginning is how do we make this capital inefficiency problem dissipate, within this
Mhm.
category of early stage venture.
Mm, awesome.
Yeah.
Um, thank you, Eric. So, I will end with a 1 minute fire round, but, like, do you have a minute or two to address the audience questions?
Yeah, let's do that.
Like, okay, so we have one question from David. He said, "What are the initial steps for an engineer turned entrepreneur to transition to the venture capital sector?"
So we talked earlier about some unique technical ability or within a technical community or developer community, some strong presence.
Mm,
And I think that has to be the starting point that says, okay, well, what's unique about your signal when you're investing in a company? So as an investor, um, that is, gets access to a particular deal. Like, why did they
Mhm.
choose you? Is it the technical expertise? Is it your thought leadership in that community? Like, it has to be something clearly articulate. It can't just be, well, I'm an ex Google engineer, right? And my
Mhm.
friend left Google to start a company and I got in, right? So that's
Mhm.
great as an angel investor if you're kind of producing a persona as an angel investor. But if
Mhm.
you want to formally become a professional investor, you've got to have a lot more substance behind that.
Mm. Okay, so we have a LinkedIn user. He said, or she said, Eric, what are your thoughts on GP carry shares sweetener versus discount on fees or carry?
Um, I think this is a good question. I think if you the discount to fees and carry generally would be something I advise if you think you're going to offer it to more than one person,
Mhm.
right? So you may structurally say like, look, all first time or first close investors
Mhm.
are going to get, lower fees and or lower carry, and then you
Mhm.
kind of publish this as the carrot to get just, anyone and everyone in.
Mm.
Um, when you're talking about kind of sharing GP, usually that, sharing GP carry in a more meaningful chunk, that usually is an anchor LP conversation.
Mhm.
So there's a little bit of a different audience depending on how you want to do that. I mean, mechanically, it kind of leads to the same kind of dollars in, dollars out, but um, how you position and who you position it to kind of get to that first close is
Mhm.
different in those two
Mm.
situations.
Um, Thank you. So the other David mentioned advice for emerging managers looking to connect with prospective LPs for fund two.
Join our community. We have a very, I mean, there's no cost. It's a lightweight process. We want to get your data, we want to get your profile. Like, that kind of gives us a great way to engage with a large, set of LPs. And you know, it's really about, like I said, I use that word matching. Is like, we're doing community events, number one, so that kind of gives you, access on that. But then when we are talking to these corporates and they're looking, like, for example, we're doing a pilot with a large corporation looking for cybersecurity funds,
Mhm.
and they want to engage with cybersecurity funds not only to access their portfolio companies, but they're also writing LP checks. So being in the database as the first screening point for us to say, here are the 5 funds that we know, that we work with. It's a little bit of a shortcut, right? Not a guarantee, but a shortcut.
Mm. Amazing. Thank you so much, Eric. Okay, we have a quick 1 minute fire round for you. What's your favorite book?
Favorite book? Well, I would say, I mean, I'm a science fiction fan, so I've gone through all the Star Trek and
Oh
Star
my
Wars
god.
stuff. So there's no real favorite there
Oh,
as
you
other
and
the other.
all my uncles. I feel like my uncles are huge Star Wars fans. Yeah.
Yeah, I so that one's I'm gonna have to pass on that just because it's hard to pick a singular one. But I would say something I'm reading now is I think it's called like the 0 second, right? It's like kind of a productivity book right now in terms of
Mhm.
how, like, kind of 0 second thinking and how you can kind of
Mhm.
train your mind
Mhm.
on making quicker decisions.
Mhm.
So as a startup CEO that's juggling a lot of balls, I like to kind of delve a little bit into some of these productivity hacks.
Mm. Who made the biggest impact in your career?
I would say it was, I've always been really thankful and fortunate that, all the bosses that I worked with over the years,
Mm.
and again, before my venture career, I worked in like risk management, and I remember um, that risk management, kind of head of risk management, brought me into
Mhm.
the kind of new division. I was like kind of a pricing analyst. So I remember that was kind of a formative moment for me to know that, if somebody sees potential in you, they'll kind of pull you up with them. And I've been fortunate to kind of been in that situation a few times. I would say more recently, I mean, obviously, people can look up my background. Spent several years at top tier
Mhm.
capital, and that was really the place that they gave me amazing license to go put capital into emerging managers, which is I'm passionate about. So kind of special call out to David York and Lisa Edgar, who are kind of my advocates there.
Mm. Who would you invite to your dinner party?
Dinner party. Well, this is okay. So this would be an interesting question. Um, I would actually invite my daughter and my daughter's friends.
Oh my god, why?
Um,
I
so,
mean, I love
well,
yeah.
my to be fair, my daughter, who's a freshman in high school, by the way, she probably wouldn't want me there,
Mhm.
but to be a fly on the wall, to think about how kind of Gen Z thinks, I think
Mhm.
would be awesome, right? In a
Are
dinner party setting. So,
mhm,
so that to me would be pretty awesome, pretty amazing. Like again, we're lifelong learners in venture,
mhm,
right? And to be
mhm,
able to open up the brain of what a teenager thinks is like,
mhm,
I think, secret sauce. Like, oh my
mhm,
gosh, imagine starting a venture fund, and then we have friends in the space that are kind of investing behind Gen Z, and there are Gen Z VCs out there. I mean, that's where the future returns are.
mm. I feel like, your daughter is probably Gen Alpha now, right?
Yeah, maybe. Yeah,
Maybe, I don't
yeah,
know.
I think
There's,
so.
like, a new term supposed to be
Well, I think we should just call it, TikTok generation.
the TikTok, the Gen TikTok, the Gen Talk.
Yeah, yeah.
Uh, where, can we find you outside of work?
I'm sorry, what was the question?
Where can we find you outside of work?
Oh, outside of work, probably on the golf course.
Oh,
Um,
wow.
a big golfer, so it's a great way for me to kind of decompress and then still have that kind of competitive spirit that's kind of internally driven. But
Mhm.
yeah, big golfer.
Amazing. Well, Eric, thank you so much for coming on the show today.
Well, Grace, thank you for having me, and thank you for all the listeners out there. And happy to follow up with anyone who has additional questions.
Amazing. Let me quickly